All right, hey everyone, this is John Knutson from Pendra Cannon. I'm here today with Mark Rossano from C6Capital Holdings, who's probably pretty much one of the top supply chain analysts and energy analysts out there in the world today. And then we have Matt Warder, who is easily one of the best at one of the now more rare coal analysts in the world today.
And what we're talking of us, John.
That's a good way to put it. I like that. I like that. Rare. That's good.
And really, the purpose of this conversation today is to kind of talk about how we're basically at the start of, we're seeing this rise of a new natural resources kind of super cycle, and all of the geopolitical events that have been happening are acting to kind of speed this up, or maybe to catalyze it. And so I kind of want to just start off there, guys. Like, obviously, the big thing that happened last week was the sabotaging of the two Nord Stream pipelines. Like, what's the impact of that, and how does that play out across energy markets, and then from there throughout the rest of the commodity markets, to impact pretty much, it feels like from our conversations before that it's going to kind of impact everything.
Yeah, there's that big knock-on effect, and when you take down one commodity, it has to be replaced by something else, whether that be coal, whether that be diesel, some other form of power. And one of the things that Matt and I have always talked about is we're short molecules. You know, when you look at the molecular structure around the world, it's just we keep getting shorter and shorter. So when you take Nord Stream 1 and 2, they weren't flowing at the time, but they were still filled, and they were maintaining pressure with the idea that there was going to be some sort of bargain that could happen, that might happen as we approached winter. And now that's gone, because when you're looking at something like this, you had all of the gas or methane at this point leave the pipeline as of Sunday and Monday, which just means that they're not coming back. Now they're filled with seawater. They were protected from the outside in terms of seawater, not the inside. So you're looking at something that would take over a year to replace that specific section. So again, this isn't turning on tomorrow. And can you replace it? And the short answer is no. Like, when you look at the pipeline capacity around there, there's some spare capacity, but a lot of it's coming from Russia. And then if you try to call anyone for a spare LNG cargo on spot or term as you get into December, January, they'll just laugh at you. It's like there's nothing available right now. Now, that doesn't mean that you can't get some adjustments as India adjusts its flow, maybe pulls some from Yamal, Russia, that is no longer flowing to the UK. They could then spot sell what that comes out of the Gulf of Mexico into Europe. So there could be some opportunities, but again, you're relying on an unknown of, are they going to be available? And then one of the things that we can also talk about is when you look at storage, because everyone likes to point to, oh, well, there's enough in storage. It's like, okay, but what was needed to attain that level of storage? How many fertilizer companies had to cut production? 70% of them so far. You have 40% cut in petchem, 30 going on 40% cut in refining. So yeah, you achieve storage, but at what cost to your economy? And as you start to ramp back up, or hopefully ramp back up, what is that going to do to your storage situation? And as you run lower, can you go out and actually source new natural gas, even if it's at an elevated price?
And so with that, stepping back for a second to kind of speak to all of us who are more generalist investors, you just said a whole bunch of things about how the gas pipeline is going to impact fertilizers and everything else. And so where does natural gas fit within the context of the rest of these commodities? And so we can kind of understand this relationship about how cutting off the gas pipeline is going to kind of cut off a bunch of other things or cause problems in other areas.
Sure. So the running joke that I always say is, like, the natural gas either keeps the pilot light on, or it's actually a feedstock coming into the process. So if you look at a fertilizer plant, for an example, to make nitrogen, ammonia at the back end, you need natural gas. Natural gas is a huge component of that whole process. When you look at refining, you have to use natural gas to create hydrogen, to create your cracking that you can then break down the crude into its different pieces. Then when you look at petrochemical side, it's either a feedstock, or for the most part, it's how they keep the pilot light on. It's how they keep everything going. But you also have the electricity side. You have natural gas fired power that is feeding down into all of these different markets. So when you take away this key input, whether it's in the cracker, a part of the cracker, the fire that is keeping the stove on, you're taking away all of this capacity that has to be replaced with something. You know, on the fertilizer side, they're now importing more ammonia to try to replace what they're doing. They're trying to import more hydrogen or create more hydrogen elsewhere to use that as an input. And all it does is it increases cost and it decreases the amount available. So that you're seeing your prices go up, but you're seeing your supply come down. And that's where you're starting to see this relationship of, okay, well, what next? You know, am I going to run more diesel to generate power? Am I going to run more thermal coal? Can I even run more thermal coal? Do I have the carbon credits to offset me running thermal? And that's where you start to see a lot of these knock-on effects throughout the supply chain.
And so then where do you think, so going back to the natural gas market then right now and kind of the energy issue in Europe that everyone's talking about, like, I guess if we were going to start with where this is going to be felt the most, the fastest and the hardest, I'm assuming it's right there. So what are the impacts going to look like there with this? And then what are their options to deal with it?
At this point, it's going to be a rise in PPI, so the producer price index. So you're going to see companies just taking in more cost. You know, their price of operations is going to go up, their price of inputs are going to go up, and that's going to then feed down to the CPI, to the consumer, because they're going to pay more for stuff. But then the consumer is going to get hit directly, especially as we head into winter, for heat, for electricity. So you're going to see, so the consumer is really going to catch it on both sides. They're going to see their prices of literally everything go up, and then prices that they're paying directly also go up. So when you look at the offset, the question is, can I actually replace it with anything at this point? It doesn't even have to be at a price that is let's just say palatable, but just can I get it in general? And that's where you're seeing a lot of these shortfalls, which is why France, Germany have laid out potential limitations and what those limitations would look like. And it's just a matter of trying to protect the volume to make sure that the consumer doesn't freeze to death. I mean, let's be fair, like this is life or death when you start getting into winter months. And things have gotten a little bit better just because we're in shoulder season, and the running joke is, you know, you sell fall and buy winter. And that's just what we're seeing now. So this is the time when they're trying to rush, make sure there's enough in storage to ensure that on the back end, you know, they'll be able to weather a polar vortex, because typically 3 days of a polar vortex can take 10 days of cover out of storage. So if you get a really cold winter or periods of extreme cold, you can drain that storage very quickly. And in the past, the view was, well, they'll go out and they'll just buy more from Gazprom and give them whatever they want. Well, Nord Stream is now gone. So even if you wanted to, that bargaining chip has been alleviated.
And so, I mean, back in that, or turn that around to on, like, what's the impact on Russia now and Gazprom? And like, I mean, they're already hurting, but what's this going to do there?
So there's two pieces to that. There's one, which is legal, because now that the pipelines have been eliminated or neutralized, you could say that this is a force majeure. So because there was a view that if they didn't make their deliveries as we got into winter, they could be sued for breach of contract, that this is now a force majeure event. But they also have to put it somewhere. And that's where you've seen more pipe gas going to China, but those aren't great economics. And that's a far way to go. And there's some areas that are just beholden to pipelines heading east to west. So there's some other pipelines that go through Belarus that obviously go through Ukraine and Poland. But where do you trust? Is Russia going to trust Ukraine? Is Russia going to trust Poland to buy? And that's where you're going to have to start seeing some potential shut-ins, which is a bigger problem for Gazprom because they don't have the intellectual capacity from an engineering perspective. They don't have the equipment. They don't have all of this different technology that they relied on the US, Germany for. That's gone. So now if you shut them off, can you bring it back on? So they want to keep this running as much as possible. And by shutting down a lot of these pipelines, they're going to see that back up and create a bigger issue as we go into the winter months.
And so they're basically relying on Western consultants to manage and maintain this entire operation.
In the past, they relied on us, and then they have tried to now go the back way. So it used to be Russia would collect everything, and then they would feed it down to Iran to help Iran maintain their production away from sanctions. Now they're running out of equipment and storage. They've run out of people that know what they're doing to the same degree, and they've turned to friends within OPEC, Saudi Aramco being the biggest, to try to help them bridge some of that gap. But at the same time, Saudi Arabia is trying to walk a line here, and they can go far, but not too far. Like, one of the things that they've been doing is they've been buying Russian diesel, running, and fuel oil, running that through their power burn for summer, and then exporting the diesel they're creating, because it's a way to naturally get around sanctions, import the cheap sanctioned stuff and export the stuff that isn't sanctioned. And they've been playing that game, and they've been playing that very well. And now the question is, does the cap happen, the price cap on oil, does that free people up to buy, let's just say Russian crude in some very esoteric ways to get around these sanctions? But so far, the Saudi Aramco has been the one that has been willing to deal the most, with the UAE and Iraq a little bit more skittish about trying to deal with Russia directly, where Saudi Aramco is the elephant in the room. They can do whatever they want, and no one's really going to say no. But again, that's a game that they're playing that might be tough to continue as we move forward.
So then, I guess the next piece of that is, if you think about, again, talking to the generalist out here, he may not have as much understanding, like the concept of baseload in energy, and how much natural gas. I guess first explaining what baseload is. How natural gas fits into that in places like Europe, and then how are they going to be able to, actually add energy? Because I think that's the thing that I'd say this is like the last 10, 15 years of like everyone talking about tech, is everyone forgets that like the supply chain starts with energy, and it starts in the ground. And when things happen in the ground to raise costs, then that's inflationary throughout the entire supply chain. So and we're feeling that now everywhere. And so I feel like if we don't understand energy right now, then you can't understand the politics of what's happening. You can't understand how to even start to think about an investment environment without this kind of base understanding of where everything starts. So could you kind of break that down a little bit? Sure.
So baseload power is power that's running 24/7. When you think about baseload, that's nuke, that's coal, that's natural gas, where things are just running 24/7 to maintain, the power that's within your lines. When you turn on the computer, when you turn on your Netflix, you're expecting that to click on, and that is that maintains a certain amount of power within your lines. Now that's base load. Then you have what's called peakers or peak shaving, where when you get extremes, whether that be extreme heat, everyone's firing on their air conditioners at the same time, you will fire up that short-term capacity, which is typically natural gas powered, because short cycle gas turbines can turn on typically between 3 and 4 hours. So when you see that peak load coming, because obviously the weather, people are going home, you'll start to fire that up to make sure that you have the capacity to meet that. Now, the problem is, as we've taken down base load, both coal and nuclear, and replaced it with this intermittent capacity of solar and wind, you've then relied more and more on the short cycle gas turbines, which are just peakers. So you're relying, instead of on the base load and then filling in with peaking, now you're taking down base load and relying more on your peaking capacity, which is an unknown, because in extreme heat, there's no wind. You may have sun, but there's no wind. In extreme cold, there's too much wind because everything is blowing 50 miles an hour, and there's no sun. So at these extreme points or on the tails, you're seeing the stress to the system that wasn't there before. And when you look at just, commentary from Germany, which I think is hysterical, they're going to shut down 1 out of 3 of their nukes, and they're going to keep the 2 on standby. It's like, that's not how nuclear fission works. Like, this isn't total recall where you put your hand in and the rods just drop and you have power. Like, that is not how this functions. So there's a broad misunderstanding. And when you start looking at wind and solar, they work. It's not that they don't work. It's just you have to respect, as Matt and I have talked about, the geography and the topography. Like, Where are you? Are you on the equator? Are you away from the equator? Are you a place that has 25-mile-an-hour winds on the regular? Are you a place that has extremes? And you have to build this, because when you take away this base load capacity, you're stressing the system. And the more you stress that, the bigger the problem. So then you take Europe, for an example, where they've been taking down coal, they've been shuttering nuclear, they haven't invested in nuclear for 10 some odd years, because they were going to retire them as we got into the 2020s. Now what? What are you relying on? So, you're relying on natural gas. Well, where's your gas coming from? How available is that gas? So then you're going to turn to, okay, well, do I have to go to what everyone likes to call gas to oil switching? Well, you've taken away that capacity. So even though you technically should, you physically don't have the ability to run that diesel. Even though you should burn more thermal, have you decommissioned, and not just decommissioned where you turn the lights off and walked away, but you literally ripped them down. So now what? And that's where we're seeing this continue to reverberate, which is why Matt and I always talk about, poor policy decisions. Though 30 some odd years of poor policies can't be fixed overnight. This is going to be a decade, 2 decades. And that's once we agree that there's a problem and that we have to fix it. Because right now there's still this back and forth of, the technology will catch up to us, which may be true. But does that mean that 12 hours out of the day, I'm not going to have power while we let the everything catch back up? Like at what point does this happen? And then you brought up bringing tech back. Well, like you look at nearshoring, onshoring, think about how much power that absorbs. We're going to bring battery capacity back to the States. On whose grid? What grid is going to sustain this? And that's where you have to get serious about, how are we building new power gen? How are we adding base load that's redundant? That's not only redundant, but efficient and reliable. And let's be fair, affordable at this point in time.
Well, and so again, these are all areas where we can deep dive a lot farther in, because to speak to the policy issue, obviously we have Matt here. I want you to talk about coal here in a second, but I mean, the disconnect between the basic understanding of energy markets and policymakers who have basically set lots of mandates, they've cut things off, they've done all these things based on really a complete lack of understanding, it seems like, of the actual energy markets. And I feel like coal is a perfect example of this. And Matt, do you want to kind of speak to that? And then with that, just to kind of, because I know we'll keep going, frame now the fact that we're dealing with this issue with Nord Stream and the impact it's having on Europe. But like you just said, Mark, this is happening against this backdrop of 30 years of policy decisions that is basically creating like this resource super cycle. It has to happen now because of this complete, like, I don't know what's the word, they're just blindness, just complete blindness to energy markets and how they actually work.
Yeah. I mean, I think the best way to kind of like understand why policy has gone down this path is to sort of realize that, even as analysts, within our own professional verticals, most of us, for the bulk of our careers tend to be siloed. Like if we're a coal analyst, we tend to stay mostly on coal. For natural gas analysts, we tend to stay mostly on gas, so forth and so on down the supply chain. And, there really aren't a whole lot of people, like Mark and myself who, have had the ability during the course of our careers to learn across commodities, right? And Vaclav Smil talks in his book, How the World Really Works, about, he's dedicated his career to this broad knowledge across all spectrums, because there's always an expert you can ask to go deep if you want to understand more. But if you don't understand how those markets kind of work together in the intersections, then how do you build a reasonable model of the world? So, for a policymaker who is, by and large, let's face it, they're attorneys, they have relatively little background in science or technology, right? They have relatively little background in mathematics. They certainly have relatively little background in physics. So what they're going to react to, like, most of the people in the financial publication industry talk about, is we talk about narrative. So you have to have a story that kind of sticks with them. And, for better or for worse, the story that is stuck is that, well, solar and wind can replace, coal and gas and diesel and all that sort of stuff. Or, that battery metals can replace oil refined products too sweet. And maybe one day they can, maybe one day. But the fact is, we operate in 2022, and the mix of the vehicle fleet is not what we want it to be in 2030 or 2040. The mix of the power generation is not what we want it to be in 2050 or 2060. So this sort of like narrative that looks toward the future as the solution for everything, I don't think is necessarily the problem, but we have to have a project manager to get from here to there. And the policy decisions that have been made to just move away from fossil fuels have this inherent deleterious effect on supply. Because if you think about it, Mark talked about retiring coal plants. Well, when you retire coal plants, you take capacity from here, down to here, down to here. What is supply going to do? Well, supply is going to go from here, down to here, down to here. Now, when you have a situation like we have now, where, we have this sort of, trifecta of baseload demand between natural gas, which, as Mark said, is really more of a peak shaving technology than it is a baseload. We're kind of misusing it from its perspective. But there's gas, there's coal, and there's nuclear. And if all else fails, there's diesel, right? Those are the four fuels that can service baseload. Those are meant to interact with these intermittent sources, which can go, up and down as it gets brighter outside, or as the wind blows generally at night. And while the idea that you can, ramp up solar during the day, and in that gap ramp up natural gas, and then pull it back down, that's real. But especially when you get into the winter, you have these other demand centers for natural gas that are pretty important, like heating people's homes. So if you think back to February in Texas, you had all of this natural gas get diverted to home heating, and so that forces baseload over to these other technologies. You either have to have coal or you have to have nuclear, and you have to rely on those. So what happened with coal in particular was that the market didn't really anticipate this, and we have this big demand increase for coal, but supply couldn't ramp up because we've taken capacity down to here. The elasticity of supply in coal is basically zero, right? So since coal can't ramp up, what we have to do, we have to burn down inventories. And when we burn down inventories and we get to a certain rate, at least here in the United States, there are certain plants that can't run below, if you get below, say, 10 days of inventory. And we are currently, both for bituminous coal and for subbituminous coal, at the lowest stockpile levels in history. Part of that's because we've retired a lot of plants, but it's also indicative of the fact that we can't ramp up supply. We have a labor shortage in rail. We can't rebuild coal stockpiles to reliably prepare for any sort of shortfall in gas for the winter. That's true here. It's been true here now for a couple of years. But if you look to Europe, not only have we eliminated Nord Stream 2 as a potential option to supply European gas markets, but also there was a ban on Russian coal. That's softening, but we have to realize 50 million tons, is about 70% of Europe's imports, of coal imports, come from Russia. That's all high calorific value coal, very high heat coal. And really the only places you can go in the world to find that are Australia, South Africa, and the United States. Back in the day, when the US had supply elasticity, we could ramp up and supply the rest of the world. And now we can't.
That's
at
why
all.
we have Mark shared that headline. It's coal past $200.
Yeah,
for the first time.
Coal right now in Europe delivered is $328.50. And to give you an idea about where that number usually sits, it's usually about 80. It's usually about $80.
So you talk about the how much about the elasticity in coal, and what's the elasticity in energy demand?
I mean, Mark talked about how much fertilizer capacity has been shut down. We've shut down electric arc furnaces for steel generation because power is such a huge input cost for that. Those aren't running right now. And if you think about Germany, that's a huge portion of its industrial output. And Germany operates the surplus that balances the rest of Europe. So if they just turn the switches on, they're going to draw down gas at a really high clip. They're going to draw down coal stockpiles at a really high clip in a time where they may not be able to replace them, or at least replace them quickly enough to satisfy through the winter. That's the difficulty we're at. Mark talked about, the level of stockpiles. Well, we got back to 5-year averages in Europe for gas. That's great. We're actually sitting at right around all-time high coal stockpiles at Amsterdam, Rotterdam, and Antwerp. That's great. But how did we get there? We put this massive bid under the market that has, 100x'd everybody's energy costs. So how that gets resolved is really key. And at least for me, I don't really see a resolution that doesn't involve Russia at this point in time. And now with Nord Stream 2, we've actually clipped off at the heels one of the possible sources of supply. I know it's not geopolitically favorable to cave and to have caved and import Russian gas, but the fact is that was an option, and now it's not. So how we go from here is important.
Well, I think that's the other thing that, again, generalists may not quite get, is that energy is life, in the sense that a lack of energy kills people right now, because it's going to famine, the cold. You think of the cold, but famine by itself is such a massive thing that this is going to impact. We know this is going to impact. So how can we talk about like the food and ag right now? What's in the short and near term here? Like, how is this going to impact that sector? Because it doesn't seem like it's going to be good for a lot of people right now.
Well, when you look at the universal issues where we've had extremes on the weather side, at this point, we've seen droughts continue to shave yield, and you're increasing the pressure on the amount of fertilizer you're putting down to try to make up for that shortfall. It's like, okay, well, I'm not going to get this much water. I'm going to try to use a little bit more irrigation, and I'm going to try to put down the excess nitrogen that normally comes down naturally in rain. So to try to bridge that gap, the problem is we've been mismanaging our soil for so many years that now we're asking it to do more without ever really thinking about soil rejuvenation, soil health. And we've reached the breaking point. And if you consider the stress that continues, back in 2010, 2011, you started to see we've always known about overfishing and whatnot, but you really started to see the yield drop on the fishing side. So then people started to turn to other replacements, whether that be chicken, whether that be soybeans. And this was a point when we were having an issue with our own supply chain. When you look at just crop availability, which then resulted in Arab Spring, peasant uprising, wheat wars, depending on where you are in the world and what it was called. But even though prices came down, they never really got to where they were. And you still started to see a lot of these stress points. Then you had the swine flu, you had bird flu, you had these continuous reverberating issues. And now we're back to 2020 onward. You had a drought, you had extreme rain, and it really destroyed a significant amount of crops. So instead of having these bumper crops or normal crops, you were actually pulling from silos. So 2020, it was like, okay, COVID, we'll get back to normal. Then 2021 happened, and it's like, all right, well, not really there yet, and we're trying to do more. And now you're in 2022, and this was even before Russia invaded Ukraine. And you were already seeing this stress. You were already seeing fertilizer prices go up. Now you have Russia going into Ukraine, which is going to take potash out of from Russia and Belarus, a significant amount of grains that normally go from Ukraine into other areas, from sunflower oils on down to wheat and corn, that is now gone. And you're seeing the stress continue to rise. And now when you're looking at trying to get the most possibly can out of your crop, oh, by the way, there's no availability because we've had to shut down and shutter all these facilities. Then you have the policymakers that are saying they want to reduce everybody's implementation of nitrogen. It's like, okay, that's great. I get it. Nitrogen has runoff, bad for the soil. NO2, terrible for the atmosphere. But what are you replacing it with? Like, where are we going to replace this? Because people need to eat, people need fertilizer, and they need gene edited or gene modified crops to ensure that they're drought resistant, they're pest resistant, and ways to try to really come to the other side of it, because people need to eat and people aren't going to stop eating. And right now, even though the food growth and growing has come down, you haven't seen people stop having kids. And so the population is going in one direction as we get a flatlining and now rolling over in food availability. And this creates protectionism. You have India that has cut and gated rice and corn exports. You have other areas that are looking to throw up some sort of protectionism to ensure they have enough food internally, and then they'll export, which drives up prices. And as you drive up these prices, you get these big and underlying issues. And that's where, when we talk about power, we talked about a lot on supply, but demand, you have the policymakers that want to electrify the homes. So electric heat, electric stove, electric dryers, they want to electrify the fleet. So they want EVs, they want charging stations. With what base load, with what power? Then over here, it's like, well, we don't want you to use as much nitrogen. It's like, okay, that's fine. What fertilizer am I replacing this with? Like, show me how we're going to solve this. And yes, I will 100% adopt your means. But there's this disconnect between, it sounds nice, it's a great soundbite, and as Matt said, it's a narrative. We're helping the environment. NO2 is 352 times worse than CO2 in the atmosphere. We need to reduce it. Great. Let's do it structured. Let's do it in a way that makes sense and doesn't actually drive down our yield, because at what point, what billion people are we going to kill in order to achieve this dream?
That's not something that's part of the policy conversation.
Yeah.
That's a terrifying thought. So, I mean, each of these things, I keep wanting to dive into each of them, but we don't have time for that. So, one thing you did say that stuck with me that was surprising was that we have not been repairing the soil. I thought that our farm and ag technology and knowledge has advanced so much that I thought that was just a basic part of farming. Is that not the case?
No, we've been asking the soil to do too much, and you've seen caloric value drop significantly over the last 20 years, where even though the ear of corn is bigger, it's actually, vitamins, nutrients, oils is much less. And we've seen this pivot point where we're at the maximum of what we can do with land. One of C6's investments in Soltech is looking to address sulfur shortages, because when you look at the needed means of fertilizer, we need sulfur, and sulfur creates sulfates. But you don't want to put down sulfates directly just because it's water soluble. It can bleed into other things. But when you take away sulfur and you take away the nutrients, you also change the bacteria that's in the soil. You can burn out the roots. You can create an osmotic situation where a lot of this has sodium as a binding agent, which is going to pull water away from the roots. But when you look at the sulfur and other shortages, you're forcing the plant to adapt, because again, plants are alive. They're going to mutate and evolve. So when you look at these sulfur shortages, these nitrogen shortages, they're changing enzymes, they're changing proteins, which are making them harder to eat, harder to digest. And there's been a lot of work done in terms of sulfur shortages and the rise of celiacs, the rise of enzymes and proteins that are making the plant harder to work with, less nutritious. And there are these underlying pieces that continue to reverberate out, where we have to get back to basics of what soil do we need and what is the seed we're going to put down. Because once we can come together with, okay, this is the soil health we need to attain, this is the pH level, this is the level of the mixtures that we need, and then we can go to the micronutrients, and then we can focus on, going further. But, right now we're taking food and turning it into fuel. It's like, is that really the best use of what we're trying to accomplish right now, as people are starving in Africa and other areas around the world?
So, I mean, it seems like when you look at this from this energy standpoint, it's a lot of scary stuff. There's the capacity, like to bring new resources online, is not a fast process in general, right? I mean, growing seasons are what they are, so like, these disruptions are going to have lots of impacts down the road here. From an investment standpoint, like what is the way that an investor should be framing his view of the world right now to start to understand how he should be making decisions?
So you always want to go down to the cheapest cost of feedstock. So when you look at where can you get the most available, readily available natural gas, it's the US. So and then at the same time, they're going to turn around to be able to sell at the market rate, which is currently at a premium. So that's where the things that we look at, Mosaic, Nutrien, those are ones that we've looked at for opportunities. CF, something similar, where you're looking at just where is the cheapest form, and you want something that doesn't have a huge reliance on European manufacturing, because that's where prices are going to be at their highest. That's where you're going to see a lot of these shortfalls. So you want to try to balance the two. Just like when we're looking at natural gas and coal, it's like, okay, well, when you're looking at natural gas, it's who has the cheapest cost and who has the availability to not only internal demand, but also the LNG market. And those are the kinds of things that we're looking at and trying to balance out from my end, where we invest on the private equity side. That's important. And then when you're looking at the actual public companies, that's always going to be the biggest piece, because there is a net shortage out there. When you look at China, for an example, China went from in 2020 having a 750, the worst Yangtze River flooding in a 750 years. And the only reason why we know that is because of the anecdotal stories of water hadn't touched the Buddhist statue in 800 years. But then you turn not even 2 years later, and now you have a drought that is the worst since record keeping began in 1867. It's probably worse going even further back, but just anecdotally speaking, you've had these extremes. One of them destroyed crops with too much water. Now this one is destroying crops with not enough water. So how do you try to implement and really try to bridge that gap? And it's with fertilizers. And they've been problematic with over fertilizing, which is equally, if not just as worse, because you destroy the root system, you burn it out, and then you can actually taint the soil itself. Because if you don't do it in the proper metrics and the proper timing, you actually reduce yield by essentially tainting the soil, and then you have to let it recoup itself and essentially adjust itself so that it can become arable again. And this is an issue that is going to continue to reverberate through the system. And you need something that's going to be resilient against both sides, extreme wet, extreme drought, with drought becoming more prolific in a lot of our key growing areas around the world.
And then, so walking out from to other sectors in resources, like battery metals and mining, like what's happening here in terms of just the policy demands, the situation in energy, the geopolitics, like what's the state of mining now as well? I mean, because that's a whole nother aspect of this that we haven't talked about. That's a huge part of this super cycle.
Yeah, it is, right? I mean, so first of all, the notion that we can somehow recycle our way to growth is a falsehood, right? It's going to take more primary material that's mined, from the ground up, and we have not made ostensibly really any investments to secure that for the longer term. There was a great article that came out in April in The Electric, which is a magazine that's put out by Georgetown professor Steve Levine. That basically said, well, if we just look at batteries for EVs, right, and we look at the amount of material available versus what car makers' projections for production are, right? I think there's only about maybe 40% of the available material to create the batteries for those cars. The math was like, and let me pull it up here. In 2022, my former employer, Wood Mackenzie, estimates that we're about 45,600 tons of lithium will be produced globally, about 300,000 tons of nickel, and about 52,000 tons of cobalt. So if you divide that production by what is needed to make like a nickel manganese cobalt battery 8 to 1, you only have enough nickel to make cathodes for about 3.8 million electric vehicles. So to give you an idea about how disconnected that is from producer reality, I think if you stacked up all the producers, soup to nuts, this year they say they're going to make about like 7 or 8 million. This is how out of touch everybody is, right? So this is before we address the grid and like battery storage at the grid level, right? Which if this is the case for battery electric vehicles, we're going to have to use a different technology to address the power grid. So this is the problem, right? Now, for going into individual verticals, like for lithium, I think there's enough lithium projects to actually get up above where we need to be. Call it by the late 2020s, early 2030s, provided that we bring on some of these projects that are in kind of earlier stages. When we look at some of the more constrained metals like cobalt. Well, cobalt is a metal that doesn't drive primary mining economics. It primarily co-deposits with copper, and we're undersupplied on copper too. So if we don't produce enough copper, which we're not, we should be back into deficit, I think, by 2024, by the middle of this decade, then there's no way that we can produce enough cobalt. So we're going to have to rely less on that going forward. Like my supposition is that if this is a hard and fast rule that we're going to have to switch over to using batteries for the fleet, then an alternate technology like lithium iron phosphate, we have plenty of iron to address that. It may, to Mark's point about agriculture earlier, it may tighten phosphate markets, which are important for crops as well. But something's going to have to give, and somebody at the policy level is going to have to point out that deficit and kind of shift everybody in a different direction. For me, I think the easiest solution is to rely more on hybrids in the interim. Explore a little bit more for hydrocarbons, although governments don't really want to. But the combination of battery and hybrid technology, and then ramping up nuclear, because nuclear is baseload. We know there's plenty of production capacity for both in Kazakhstan and at Cameco's operations in the Athabasca Basin. But that's there's a lot of red tape involved in both of those transitions, right? You have to get buy-in from the car manufacturers, and you have to get buy-in from government, and unfortunately, that's going to take a different narrative to catch on. One that I hope it'll be folks like myself and Mark, and our other analysts and kind of like thought leaders, within the financial and commodity research space that'll do that. But this is not I guess a typical sort of relationship that these industries have developed over the long run. So we've got our work cut out for us in a lot of ways.
And then off that, two other key points when you look at Russia, and Russia is kind of like the crown jewel of big bad fossil fuels. It's like, well, how reliant are we going to be on for China? Like, how much does China do on terms of the processing, the mining, depending on which part of the supply chain you're in, they control up to 70, 80% of it at different points along the line. So if we're talking about everything that Russia's doing, are we really going to then rely so much and so aggressively on China and their supply chain, where we saw in 2020 what can happen when you rely on such a finite breadth in terms of the supply chain piece? And then one other component that is interesting, when you look at, there was a big battery fire in California that was spewing out toxic smoke. Now, if a refiner has an unplanned flaring situation, they get fined. Like, that is a track thing. They get fined for that. If a battery catches fire, batteries are not meant to catch fire, even if it's an accident. Again, like, the refiner's not purposely doing it, but they get fined because they released chemicals into the atmosphere. Shouldn't the battery manufacturer get fined? Like, at what point are we going to look at this honestly and say, we need to hold them both to a standard, because a chemical fire coming from a battery is not exactly something the atmosphere really needs right now. So we need to look at some of these pieces in terms of, well, what is the risk of a battery fire? What is thermal runaway? What are we going to do to be honest about this? And how much are we willing to rely on this Chinese supply chain when we know that there's issues there from human rights on down
Mhm.
So we're just going to jump from the frying pan into the fire, and without really considering about diversifying and becoming ourselves more aggressive in managing our own supply chains away from, the Chinese and other types of their holds on African raw materials.
Right. There's definitely been a gap between the ideals of what we would like our energy situation to be and what the practical realities on the ground are. And there's been kind of just a refusal to acknowledge or look at that gap. And I feel like that's possibly one of the things that the situation with Russia invading Ukraine is kind of creating, is everyone's kind of forced to look at the realities of energy. And like you said, like nuclear is the only real option for baseload outside of fossil fuels. So if you don't want fossil fuels and you don't want nuclear, what on earth do you want? Because you can't have it all just out of thin air. So until there's some new technology that's advanced and can be scaled out across the world, which I don't think anyone can, I don't care what if you came up with a new energy technology today, how long would it take to scale it? Even if it was like everybody loved it and worked, it's still multi-decade long project. So
yeah, exactly. And I mean, even if you wanted to go down the hybrid plus nuclear route, like we have to make those decisions now, because it's going to take 7 to 10 years to build new nuclear plants. It's going to take, if you're going to go down the lithium iron phosphate side, it takes 7 to 10 years to bring on additional spodumene production. So like, a lot of these mines, a lot of these operations we're building from scratch. And there's of course that level of bureaucracy that goes into propagating nuclear as well. So like, this is one of these things where we got to jump on it, and we got to jump on it really fast. We have to, be able to kind of unlock, the finance industry's ability to actually capitalize these projects, right? They can't be, handcuffed to capitalize oil and gas exploration. They can't be handcuffed to capitalize copper and battery metal exploration. They can't be. They have to allow for a new supply to come on. And we have to have a pretty reasonable rate of return for them to sort of do so. Prices are already at the point where that's okay, but this takes so long that we have to start now.
That's a really interesting point too, because you have the fact that like so many funds and so many people are like you said, handcuffed from investing in things like coal, or the narrative is such that they're not going to invest in a new mine. But that is the venture side of the resource market. And if we're talking about needing to bring on more resources, and it takes longer to go to actually develop it, the investors who have more flexibility and fluidity, like in their decision making, like family offices and things like that, there's probably a lot, I would imagine, a lot of opportunity for those types of smaller investors to come in and actually clean up quite a bit, because the demand is there. There's no supply. It's a basic kind of it's a basic dynamic, and you have policies, both governmental and corporate, that are stopping other people from investing in that. And so it seems like a wild inefficiency that's there for people who are looking to take advantage of it.
Well, and that's why I started the private equity fund that I did, because that's where we see this opportunity, where there's this middle market, because Carlyle, Blackstone, they won't wake up unless you're talking about 800 million or more. And then banks and everyone else are hamstrung in terms of legal red tape. What do people want? Like, we're buying hydroelectric dams because they're small. There's a lot of uplift we can do. But when you look at it, some of the when we pitch to investors, they go, well, what's the biggest risk? I'm like, well, I guess if the federal government said we're going to build 300 gigawatts of nuke, that could be a problem. But as Matt outlined, what's the red tape? What's the timing? Where did you get the fuel? Where do you make the fuel? I mean, we have 40% of nuclear capacity and enrichment comes from Russia. So we've talked about how coal's not coming from Russia. We've talked about how natural gas is not coming from Russia. What about the uranium coming from Russia? There's so many knock-on effects when you look at this. So to your point, especially as rates go up, and because again, you talked about family offices and small family offices. So we try to pitch to them, and their whole thing is, well, I can go into real estate, and real estate is going to be great. Now, as we start to come back into a normal market of rates and hurdle rates, and again, rates going up is going to make some of these mortgages, some of these rents unattainable. they have to look at something else to do with their money. And because you have essentially this bottleneck, because of ESG, because of some of these strategies, you have some flexibility. And I think as they kind of look at their rental properties, and they're still cash flowing, but they've usually taken that cash and reinvested in real estate. Well, maybe you take that cash flow and you reinvest in something else similar to real estate. You're still buying land. It's just you're going to do something with it, whether that be a means of production, some sort of entity. And then because there's such this concern about supply demand, you can get a long-term takeaway contract. You can get some sort of, let's call it a bankable deal, where I know what my feedstock is, I know what my end stock is, and I'm just going to clip in between, and I can borrow X against that at a specific rate. And I think as you start to see this filter through, you will see more money come available. You will see some of the smaller entities get involved, because I think there you have a good 10, 20 years of returns before anything meaningful happens on that geopolitical and or political pivots.
Well, since we're going to you have something to say, Matt? Go ahead.
Yeah, I do. And sort of highlighting something that Mark says. I mean, I agree that small family offices, smaller RIAs, like those kinds of operations have a real opportunity to step in and be a hero. When the iBanks wouldn't. But Mark mentioned, a lot of their focus was on real estate and how, at higher interest rates, that's not going to be there. Well, lower interest rates is also what made renewables cheap for a long time. And, if interest rates are going to be up here, in this regime for any period of time, it's going to be much more difficult, even to finance them. So the higher rate environment, I think begs the question of like, well, what is the market for these projects going forward look like? How are we going to subsidize them? And then alternately, like, how does that factor back into, our own sovereign debt position, which is, I'm not the best, fixed income analyst, but at least for me, like that's an existential concern,
And that's a great point when you think about hurdle rates, because if solar makes sense because the hurdle rate is so low, I'm borrowing at 2%. So do I really need to make a great return? Now, as you start to see things go 7%, 8%, well, what's my hurdle rate now? And that's where you're going to start to see these pivots where I'm not going to do real estate as much. That technology makes it a little bit difficult. And you saw a lot of investment in VCs and VCs and startups are going to take a lot of time. But what's my risk? What am I borrowing money at? When you're investing in some of these things at 1-2% carry, okay. If it works in 5 years, great. If it doesn't, I have 10 others. But at a 5-7% hurdle rate, well, what's my cost to capital now? Like what's my opportunity cost? And I think the bigger arching, broader thing, which is I think good in terms of reevaluating zombie companies and some of the ways people have invested over the years, I think you're going to get a more true up to those hurdle rates. And as Matt pointed out, maybe that solar doesn't make sense. Maybe it makes sense to go somewhere else. And reinvesting in real estate is a little bit harder. So now you have this pile of money that has to get redirected, but it's like moving an aircraft carrier. This is not something that happens overnight. This takes time, but then once it does pivot, you get a very big and aggressive move. And I mean, selfishly speaking, that's what we're hoping for prior to whatever 2023 may bring. Get that fundraising, get this stuff deployed, because panic can set in when you get a lot of volatility. But as the market kind of picks a direction up or down, is actually irrelevant, because as long as it picks a direction, people can plan. They'll start to distribute capital in a more effective way. And then you'll get a little bit more running room on what your investment looks like, what your interest rates can look like, and what your return on capital can be over, a 1, 3, 5, 7 year type plan.
Right. I think you said it in a really great way in one of our other conversations offline, which was, I think the way you phrased it was, people need to realize that there is no more endless liquidity. And so like that in and of itself, I feel like, if you took all the other stuff off the table for a minute and you just looked at the fact that the interest rate environment is changing and endless liquidity is maybe going away, like this is in and of itself a massive transformation of how everyone's gonna have to make their decisions. And so could you kind of walk us through kind of the impact of and the reasons for this change in the interest rate environment?
Sure. I mean, we've had QE, quantitative easing into infinity. You had Japan kicking it off in 1998, and then the US and everyone else joining in as we got to the end of '08. And the view was, and again, Greenspan set rates low, and then we started to see this continue cascading down where you had nothing but liquidity available. You had rates that were low. There was a ton of money coming through. Anytime a central bank even thought or had a dream about a quantitative tightening, the market would panic. And then central banks would be like, oh, no, we were just kidding. We just wanted to kind of test the market to see how everyone was going to handle it. So now you have with the law of diminishing returns, where every time you have a new easing process, you have to increase exponentially the amount of easing. But then not to go too deep into economics, there's a point where no matter what, it's a negative util, which just means that it has a negative effect on the economy, where no matter how much new money you put in, it means nothing. And that's where we sit right now, where no matter how much money's going in, it's sloshing around. You have no buyers. And Matt and he's probably gotten so sick of me hearing me quote this. Who is your buyer of last resort? Who is your buyer? At 4 different times throughout the last 20 years, it was China. For multiple different times, it was Japan. Then, this past time, it was the Fed. The Fed was the buyer. For some reason, they looked at the housing market in 2021 and thought it was still a good idea to buy mortgage-backed securities. Where they thought we needed support on the housing market is beyond me, but they continuously did this. So now we're in a position where they never tightened. And I always describe it as a bow and arrow, where if you pull back that bow, that arrow is going to fly. But the more you do it without tightening that string, the arrow is not going to go as far, and then it's not going to go as far. And then eventually it doesn't go anywhere, and it just drops to the ground. And that's what we're sitting right now. You don't have the ability to come in a meaningful way and to provide that liquidity, to provide that backstop, adjust bond volatility, adjust rates, because they've just done it endlessly. And this is where it goes. Like I always joke that you can hold back the invisible hand for so long until it comes back around and slaps you in the face. And that's where we're sitting right now. And now everybody's getting hit with bond volatility, with rate volatility. And everyone is still saying, oh, there's a Fed put, they're going to step in. It's like, where? At what point? If you look at wages have gone up, but housing prices have gone parabolic. So do you want to risk a wage spiral, which is near impossible to collapse, which we saw with Volcker trying to step in to adjust that? Or are you going to send things down with housing prices in the economy to avoid that? And I think that there is still that back and forth on what is central banks going to do. And you saw in the Bank of England. The Bank of England said, we'll step in and we'll buy long dated debt up to 80 billion, but we have to go away again. Like we don't have the ability to come through. Mm-hmm. And then the federal government is like, oh, don't worry. 1972 type tax cuts, we're good. And so it's like, you understand that tax cuts increases the money going to the people, which is going to help drive inflation. And you want people to consume less, not more. So the BOE is trying to raise rates and bring the money supply down. And yet you have the federal government that's just dumping new liquidity into the market. And it's like, you understand you have to be on the same page here. Like, I'm not saying that because the Fed and the government are supposed to be separate, but one's supposed to do short term, one's supposed to do long term. And obviously the Fed is supposed to do the longer term, but you would be surprised to know that based on what we've seen over the last 20 years. But this is where we're now stuck, and there's so much froth and there's so much just excess capacity out there that we have to absorb it, and we have to continue to absorb it. And that's why that liquidity going away, you have that funny money like Dogecoin and other types of just fun little like, oh, we're just going to make 1 billion% in 3 months. That doesn't exist anymore. That is gone. And I think people need to adjust the way that they invest in, and look at it saying, what can I do that's going to be protected from an inflationary environment, a deflationary environment? I want to own hard assets that I can touch, feel, see, that has a certain calculated multiple, given that it's throwing off very repeatable cash flow. And I think that's where we're starting to get back into that regime of, I'm going to call it responsible investing. People may fight me on what's deemed responsible. But yeah, I mean, when you see things like that, but again, it also comes back to our conversation about electricity. Crypto needs servers, it needs data centers, it needs capacity. On what power, on what grid, at what cost? So that's when you start looking at these different pieces across the investing supply chain.
Yeah, yeah, and that's a whole other thing. The amount of energy that would be needed on that side. And it does feel like, I feel like last year, 2021, felt like the, I don't want to say blow off top on cap raise, but I know guys who were like, I've raised $7 billion at their iBank in 2021, which is like triple or quadruple their best year ever before. And you saw the crazy raises in some of the venture sides. And then this year, it's all kind of like just dropping off. And I hear this from lots of people who are like, I don't think I'll ever see another year like 2021 in my career.
I think that's right. I mean, Mark is basically saying, well, guess what, boys? Liquidity is going in the other direction. It's not because people don't want to provide liquidity to the market, it's that they can't. There's not going to be that level of money sloshing around the system like there was back then, because there's not an excuse to throw it out there. We may try to find one, but we saw with Great Britain, like it's not going to be received well by the market at this point in time. Like the one thing that I've kind of taken away from all this is like, wow, markets are still working, right? They're providing a feedback mechanism to us via price, or interest rates in this case, that is pretty clearly saying to us there's a problem. There's a structural problem in the global economy. And now the question is, can we convince non-expert attorneys who are in charge of policy to listen to those things? I don't know that we can, but I know they're going to have to at some point in time, whether they really want to or not, and whether that's by dint of, brute force, brute market force, or, folks like us actually having a conversation that kind of catches on in a little bit more organic manner. It's going to happen one way or the other.
And when you look at dollar availability, that's the world at large has gotten drunk on liquidity, especially dollar liquidity. And as that disappears in different ways, you're going to see a lot of stress, because through 2014 and on, companies and countries issued dollar denominated debt. Why? Because it was cheap. It was easy. You had all this money, frothing around, and they wanted to make it cheaper. So you don't need an interest rate swap. You don't need a forward contract to trade. I'll just pay you in dollars, which sounds great when dollars are cheap and plentiful. But the moment they start to go away in any meaningful way, all of a sudden that debt is no longer cheap. It's super expensive, and now becomes a going concern as you look at banks in terms of what is their bad debt expense. You look at China, where their property values have diminished. So you already had a bank that was that was levered 34 times. You're now telling them that they have to lend more to, let's just say, questionable credit worthiness at a lower interest rate with less capital to back it up, but yet you're cutting by 40% all of their asset values. So that 34 times can become 44 times, can become 54 times. And for every dollar move, it's exponential. So when you look at the stress, when you look at what is happening, I mean, look at Credit Suisse just now. In terms of the issues that are continuing to reverberate, this is not a contained thing. This is not a bubble that everyone's like, oh, don't worry, it's just in China, it's just internal. Oh, don't worry, it's just Credit Suisse, it's just internal. It's like, that is not how this market is currently structured. There is a lot of connections. There's a lot of knock-on effects, and you have to look at this as Matt was describing. We look at these things as a flat line, not siloed, but where is one connected to the other? And that's what you have to see. It's just, where is the risk? And it's very hard to quantify, which is why we've talked about going back to simplicity, looking at things that are easy to touch, feel, see, because we are short molecules. And this is why it's going to be more like the 1970s, where inflation still remains sticky, and yet you're in a recession, but because you don't have enough supply, both of which from just poor economics, but also through poor policy. And that's what we're seeing happen again.
Wow. All right. So I think that we covered a lot of ground there. What would you, if you were going to just kind of frame it kind of as an ending for an investor, like, you know, what's the line that you have for them? Like, sum it up for, like, how should they be looking right now in a nutshell?
Matt, you want
That's
to
a
take that
good
one
question.
first?
I can try to go first. I mean, for me, I think it's, you know, a couple of things really. Number one is, I think we have to recognize that interest rates are going to be high for a while, and that impacts, I mean, literally anything with rate sensitivity that requires, you know, a low hurdle rate to come into the market. So that's, you know, sort of more advanced tech, you know, things like that are going to have a really tough time sort of existing over the next at least couple of years, right? So, and at the same time, we have this, you know, what looks like the beginnings of, you know, a global currency crisis, similar to, you know, what happened in Asia in 1998. You know, and I think, like, instead of, I think if I had one thing to say, it's like I'm looking at, you know, investing in sort of the real economy, right? You know, the stuff, you know, the commodities, you know, on and off. Each one has their own cycles, but I think commodities and to a lesser extent, you know, precious metals, I think right now are at you know, comparatively low values relative to, you know, where energy costs have gone, for instance. But at the end of the day, I think you know, at some point in time we may see a resurgence in popularity, or a pivot from, you know, from the investment community, you know, kind of back into that sector, you know, at some point, because of the risk that, you know, that Mark was outlining with regards to global liquidity. And that's really when we have situations where, you know, global GDP stalls or declines, and then we either have, you know, sticky inflation, or alternatively, the, you know, disinflation that happens. That's usually, those are the two economic conditions under which, you know, gold and silver usually do comparatively better. I don't think we're quite there yet where they're really going to outperform other assets, but I think that's something that, you know, I think that's something that we have to begin to think about. So, you know, you know, for me, it's like, you know, longer term, I'm long hydrocarbons, I'm long, you know, constrained supply chains, long battery raw materials, I'm long, you know, logistics, you know, during up cycles. And then, you know, I think this is a good point in time to start thinking about precious metals as well. Like, and then on the short side, I think we're broadly short tech for a while. There's some aspects of tech, I think, that are better positioned here. You know, we've had this, you know, really kind of like severe sell-off in semiconductors due to a lot of the factors that we were talking about, whether that's a slowdown in industrial manufacturing, or you know, a slowdown in like in crypto. Like there's less demand for, you know, VGA cards, which process the you know, the calculations and everything. So, but I think a lot of that has been pretty well priced in, and really semiconductors and that industry is now more commoditized than ever, right? They're less of a high tech, you know, vertical, and more of just kind of the culmination. They're like one more downstream application of raw materials costs. So if we're bullish on raw materials, I think, you know, longer term, we have to kind of be bullish on, you know, these burgeoning kind of new commodities, and then bearish interest rate sensitive technology. That's kind of how I'm looking at it right now.
So I would say is, you know, based on everything we've talked about, I don't want anyone to come away and be like, oh, these guys hate, you know, ESG, or these guys hate solar or wind. Like, that's not true. There is a place for everything. And that's where Matt and I have constantly talked about, like, the basket approach and the means of balancing, you know, load capacity and taking, you know, to heart what, you know, is there a river I can dam? Is there a river I can maximize? Is there the topography there that's going to allow it? But one of the fun headlines which came out while we were talking is the UN calls on Fed, other central banks to halt interest rate increases. And then you have the powers that be or the brilliant minds talking about how this is the worst policy decision ever done. It's like, so you held your tongue for 20 some odd years of terrible central bank policy, terrible management of liquidity and rates. But this is the worst of it. It's like, guys, like nobody was saying anything for 10 years when rates should have been 3% higher. Nobody said boo. Everyone was just frolicking like Scrooge McDuck throwing coins in the air without actually saying, hey, maybe we should pull back because we may need to ease again. There is a thing called the business cycle, as much as some very let's say hedge fund managers that like to be in the press like to say are dead, as well as our Treasury Secretary, but that's neither here nor there. But I think when you're looking at investment, echoing Matt's point, you have to get back to basics. You have to look at what is the supply demand model telling you? Where is the investment where I can get a sizable return with a certain amount of, let's just say, recession agnostic? Selfishly speaking, we're investing in base load capacity, we're investing in fertilizers and ag, and we're investing in renewable diesel. So we're investing in things that we don't think are going away, that are short in the market. And even if you have a recession, you're going to have a beholden buyer. And that's when we have to look at bringing down the cost to the farmer. We have to look at bringing down the cost to the employer, to the consumer. And the only way to do that is to get really serious on what does that supply demand model look like? What does the physics tell us about solar availability, battery storage, and the like? And again, there are places that battery and solar will be absolutely killer. And I don't mean that in a literal sense. It's just, though in some places that is a literal sense. But then when you look at just against that balancing approach, be able to have that conversation. And hopefully the Fed doesn't panic, because I know people may hate me for saying it. We really need to get serious on driving rates higher, creating a more normal market, because short-term pain now will provide long-term gains once again. And I think we have to get serious on adjusting for that and accounting for it when you start looking at investments and the kind of returns that are needed. Instead of it being 3,000%, upper teens, low 20s looks very attractive especially when you get it with very little volatility in between.
Fair enough. All right, guys. Well, I appreciate this today. This was awesome. Thanks a lot. So I'll talk to you guys later. Take care.
Thanks a lot,
you.
John.